How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be taking a look at a GAO report, Government Accountability Office report on the Treasury's actions during the financial crisis and bank failures of early 2023. Were their actions prudent? Did they do the right things? We're gonna take a look and find that out. Now, hang around to the end because I'm also gonna recommend some other reports that kind of I think correlate and go hand in hand with this report to kind of back up some of the findings and things that we're going to look at here. But let's bring this up real quick and let's take a look. So this is the GAO's website, and you can find this report at the GAO, www.gao.gov. We come on, they have a lot of different research, a lot of great things on their website if you've never checked it out before. But we can see here on the website, they give us basically the highlights. We can click on the full report. We can click on GAO contacts. So very nicely laid out here. So let's just take a look at fast facts. So the Federal Deposit Insurance Corporation can protect uninsured deposits at a failed bank if the Treasury Secretary determines that doing so would mitigate serious economic problems. This is known as the systemic risk exception. The Treasury Secretary invoked this exception for two banks that failed in March of 2023. The Secretary received recommendations from the FDIC and the Federal Reserve before making this decision as required. Our analysis found that this decision likely helped prevent further financial instability. Financial conditions worsened sharply immediately after the failures, but most appeared to stabilize by the end of the month. So what did the GAO find? Basically, they found that you had kind of immediate effects, intermediate effects, and then long-term effects. So the immediate effects basically were deposit outflows, liquidity pressure. The intermediate effects were basically corporate disruptions, reduced credit availability, and then the long-term effects were basically broader effects, weaker economic performance and further damage to financial markets, and then reduced market confidence. Depositors and investors have less confidence in U.S. commercial banks. But ultimately, what the GAO was trying to find out here was they were trying to do a review of Janet Yellen and the Treasury, like what were their actions during and after this financial crisis, and did they do it the right way, and did those actions really prevent what they were trying to do? That's really what this report. It's a kind of a secondhand review of what was going on. So why did GAO why GAO did this study? So in March of 2023, the federal government worked to stabilize the banking sector following the failure of Silicon Valley Bank and Signature Bank. Based on recommendations from the FDIC and the Federal Reserve, and in consultation with the president, the Treasury Secretary invoked the systemic risk exception in the Federal Deposit Insurance Act. This decision allowed the FDIC to protect all deposits, including uninsured deposits at both failed banks. The Federal Deposit Insurance Act includes a provision for GAO to review the Treasury's decision. And then it talks about basically all the things that GAO reviewed and compiling and putting the report together. Now, the nice thing is they give us this really nice kind of one-page overview of everything here. I can kind of blow that up for everybody. And basically, it just covers what we just talked about. Why GAO did the study, talks about the kind of three main things here. This report examines: 1, steps taken by the FDIC, the Federal Reserve, and the Treasury to invoke the systemic risk exception for Silicon Valley Bank and Signature Bank. 2, the likely effects of invoking the exceptions for these two banks. And number 3, and this is, I think, the most important thing, the potential unintended consequences of the systemic risk exception on the incentives and conduct of insured depository institutions and uninsured depositors, and proposals that may help mitigate such effects. So, and then, like I said, it goes through, what GAO found, and it goes through, the three effects that we already discussed. And now let's get into the report here. So now this is a 46-page report, and I just want to show you guys the two parts that I think are the most important. So the first thing is the findings. What did they find? So it basically says here, our findings suggest that the FDIC's actions likely help prevent further financial instability. However, it is difficult to isolate the impact of the FDIC's actions because it is not possible to know how the indicators would have performed without the use of the systemic risk exception. Further, the Federal Reserve's announcement of the Bank Term Funding Program, or the BTFP, an emergency lending facility to boost liquidity at depository institutions, coincided with the systemic risk exception. This overlap makes it impossible to separate the impact of the systemic risk exceptions from that program. Similarly, FDIC, Federal Reserve, and Treasury assessed the effect of FDIC's actions on the banking sector. Staff of the three agencies told us they believe that FDIC's actions contributed to minimizing contagion in the U.S. banking system. However, FDIC and Federal Reserve staff acknowledged that it is difficult to directly attribute changes in economic conditions and depositor behavior to FDIC's assistance. Through their monitoring activities, the agencies observed the key contagion risks dissipated or stabilized following the emergency actions taken during the March 10th weekend. For example, the Federal Reserve's May 2023 Financial Stability Report found that small domestic banks initially experienced rapid deposit outflows after SVB and Signature Bank failed, but these outflows significantly slowed by the end of March. Okay, so there's the findings at the end, but now I want to take a look at, I want to scroll down here, and I want to look at what are considered basically potential unintended consequences here of what's going on. So, okay, so specifically, the systemic risk exception can increase moral hazard and the risk of bank failures by providing explicit deposit guarantees and implicit guarantees, such as backing uninsured deposits. FDIC may create incentives for banks to engage in riskier behavior, such as investing in riskier assets or increasing risky lending, according to literature and academics. Furthermore, the systemic risk exception may reduce depositor monitoring of their bank's activities, encouraging banks to take on excessive risk, according to literature. This is because deposit insurance expansion may cause depositors to be less careful in selecting and monitoring their banks. If depositors feel less afraid of losing their deposits, they may also be less likely to withdraw their funds from risk-taking banks, weakening the relationship between risk and bank funding. So there, yeah, I think there's a big problem with the moral hazard. Now, and we could kind of get sidetracked on a lot of conversations here with, the bank. Like one of my biggest problems with this whole situation is that, politics unfortunately ended up playing a very large role in what happened. Signature Bank was a bank in New York. Silicon Valley Bank is obviously out in California in Silicon Valley. You had a lot of super wealthy Democrats that, had their deposits at these banks. And, a Democratic administration, a Democratic president, obviously they were more than happy to go and basically secure the deposits for some of their big donors. That to me is a problem. And if you don't believe that was the case, when Janet Yellen got called before Congress to testify about this, she was asked by one of the senators from Oklahoma, hey, if XYZ bank in my state failed, would you have stepped in with this risk exception and covered all their deposits? And she flatly said, no, I wouldn't have. So again, you get into this situation of the government kind of picking winners and losers. So which really, should not happen. The other side of this is the actions of the Federal Reserve. The Federal Reserve has created what I have called for the last 16 years, the all bailout, all the time economy. Anytime one of the big boys, whether it be a bank or a hedge fund or somebody gets in trouble, automatically they come running in with the bailout. And thus you have this giant moral hazard. And I do believe you will have a problem with future risk taking, other things going on, because they've set the stage for it by picking winners and losers, by bailing out the big boys and not bailing out the little guy. They have set the stage for this, that one day something will happen and they'll basically say, oh, well, we can't, moral hazard. We can't do this, can't bail out the little guy. So, so there's some issues here. Now, all that being said, let's take a step back for a second. This report, basically, did the Treasury ultimately act accordingly? Yes, I believe they did. Did they do anything wrong per se here? No. On the surface, no. They followed as the report shows, they followed the workflow. If we go back up here at the beginning of the report, they actually have a pretty good workflow right here. So basically, this was the workflow. The triggered event and collaboration. Goes to the FDIC and the Federal Reserve Board recommendations, Treasury determination, and then the FDI Act accountability requirements. So they followed the chain of command. They went through. They did all the things they were supposed to do. And ultimately, did it work? Like, did they stem the crisis? Did they prevent it from? Did they prevent further damage? Yes, they did. By doing what they did prevent further damage. They stabilized the situation and were able to get through it. A couple other banks. They don't really talk about Credit Suisse. Don't really talk about First Republic Bank, another bank that basically kind of like collateral damage, if you will, other banks that ended up going down. But ultimately, I think this was a good report. I think it was a very informative report, just explaining, kind of what happened, the situation, the actions taken by the Treasury in conjunction with the Federal Reserve and the FDIC. So, so very good there. But I do think that there are some deeper, things to this conversation. Like I said, about the government picking winners and losers, about the Federal Reserve and kind of they're creating the all bailout economy. I think there again are much deeper conversations that need to be had around this, but it's always good, to have this, have the GAO do this report. And I'm going to show you some other reports here real quick. Some other things that I would tell people to probably check out in conjunction with this report. So we have the GAO report on the federal home loan banks, their actions related to the spring 2023 bank failures. This is a report that came out on March 8th of 2024. So on this new report, we got to see what the Treasury did. On this last report last year, we got to see, well, how did the Federal Home Loan Bank act, during this crisis? So I would tell you to check that out. Here's another interesting one. This is from the New York Federal Reserve Bank. This is a report that came out in May of 2024, and it was revised in December of 2024. But this is called Tracing Bank Runs in Real Time, and they basically looked at how we use high-frequency interbank payments data to trace deposit flows in March of 2023 and identify 22 banks that suffered a run significantly more than the 2 that failed, but fewer than the number with large negative stock returns. The runs were driven by a small number of large depositors and were related to weak balance sheet characteristics. However, we find evidence for the importance of coordination because bank runs were disproportionately publicly traded, and many banks with similarly bad fundamentals did not suffer a run. Banks survived the run by borrowing new funds and raising deposit rates, not by selling securities. So very interesting findings here. So we had the 2 banks that failed, but there were 22 other banks basically that were on the brink of failure, that had experienced bank runs and basically found a way to, barely eke it out. And then finally, this perhaps I find to be the most interesting one. And this was from the Federal Reserve Bank of Chicago. And this came out in May of 2023. And this was a retrospective on the crypto runs of 2022. And this basically leads into the theory that I have, that the crypto collapse, the crypto winter, they call it, of 2022, which culminated in the failure of FTX, ultimately led to the banking crisis that we experienced in early March of 2023. And they talk about here all the crypto firms that failed and basically come down here. And then they talk about the runs on these cryptos and basically how it all tied back to, you can see here some great charts here. It all started with the Terra collapse and then culminated with the FTX collapse. And then basically how that ran into the bank failures at Silvergate Bank, Signature Bank, and Silicon Valley Bank. So just some other, I think, really interesting reports to look at in conjunction with this. But like I said, this was a really interesting report that came out that I wanted to cover. Some good stuff, again, looking at the GAO. So there you have it. And with that being said, I'll wrap up by basically saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And I would be very interested to hear your comments on this particular report and this particular topic. And as always, remember to check out some of the other content on the channel. I hope everyone has a great day out there. Thank you for listening, and I will see everyone again real soon. Thanks a lot.